Every week, most of us spend about $20 without even thinking about it. Coffee here, snacks there, a quick online purchase that feels too small to matter. And because it feels small, most people never think of investing that money. They tell themselves the same thing every week. $20 isn't enough to make a difference. But what if that same $20 per week could eventually produce over $4,800 every month? Not from selling investments, not from timing the market, but from income that simply arrives. That's exactly what we're going to break down in this video. First, we'll look at what this money is actually supposed to do in real life. Then we'll walk through how dividend income grows, how reinvesting those payments compounds over time, and why even a small amount like $20 a week can change your financial future. And by the end, I'll show you a portfolio that can potentially turn that $20 weekly investment into more than $800,000 and produce over $4,800 per month in dividend income. But before choosing any investments, we need to understand something much more important, what this money is meant to do. Because most investing conversations focus on growth. Growth sounds exciting. Your portfolio gets bigger, the numbers go up, but there's a problem with growth alone. Growth doesn't pay bills, at least not unless you sell your investments. And when you sell assets to create income, you slowly reduce the portfolio that produced that growth in the first place. That's why the focus in this strategy is different. The goal is not to beat the market. It's not about chasing the highest returns. The goal is cash flow, money that shows up regularly, money that arrives whether markets are rising or falling, because cash flow changes how investing works in real life. Instead of waiting decades to sell assets, your investments begin producing income that you can actually use. That income can cover bills, it can reduce pressure to work, it can create options, and it can turn investing from something abstract into something practical. For this video, we'll aim for a specific target, about $4,800 per month in income. For many households, that amount could cover most essential expenses, rent or a mortgage, food, utilities, insurance, maybe even some extra breathing room. For some people, that kind of income could replace a paycheck. For others, it could simply remove the pressure of needing one. But here's the key idea. This target becomes meaningless if it requires hundreds of thousands of dollars just to start. That's why this strategy intentionally begins small, very small, just $20 per week. For most people, that amount is manageable. It doesn't change your lifestyle. It doesn't require major sacrifices. And most importantly, it's small enough that you can stay consistent. Consistency is what actually drives results in long-term investing. Not huge deposits, not lucky timing, just steady contributions repeated over time. Once you start with a small weekly amount like this, the strategy has to follow a few important rules. It has to stay simple. It can't rely on perfect timing. It can't depend on big bets. And it shouldn't require selling assets later just to become useful. The investments themselves need to start doing their job while the portfolio is still growing. That's exactly why dividends fit this strategy so well, because dividend investing works differently from traditional growth investing. When you buy a dividend-paying stock, you're buying a small ownership stake in a real business. When that business earns money, part of those profits gets paid to the owners. And since you're an owner, part of those profits come to you. That payment is called a dividend. It's not extra money. It's simply a share of profits the company already earned, which brings us to the most important question. How much income does that ownership actually produce? That's where something called dividend yield comes in. Dividend yield simply tells you how much income you receive compared to what you paid for the investment. For long-term investing, a yield somewhere around 3% to 5% is usually considered a healthy range. High enough to produce meaningful income, but not so high that it puts the company under pressure. because extremely high yields often come with hidden risks. Sometimes a very high yield is a warning sign that the dividend may not last. But yield alone doesn't tell the full story. What matters even more over time is dividend growth. Dividend growth measures how quickly those payments increase year after year. And this is where things become powerful. If a company grows its dividend at 6% or more annually, a payment that feels small today can eventually double without you adding any extra money. At the same time, there's another factor working quietly in the background. Share price growth. As businesses grow earnings, their value often increases. Over long periods, healthy companies tend to grow their share prices in the mid-single digits or higher each year. That price growth supports dividend increases because the business itself becomes stronger and more profitable. And when you combine all three pieces together, something interesting happens. Yield produces income today. Dividend growth increases that income over time. And price growth strengthens the business that makes both possible. But there's one more piece that truly accelerates everything. And surprisingly, it's something many investors overlook. It's called DRIP, the Dividend Reinvestment Plan. And this is where dividend investing begins to feel completely different. DRIP stands for the Dividend Reinvestment Plan. And while the concept sounds technical, what it actually does is very simple. Instead of receiving your dividend payments as cash, those payments are automatically used to buy more shares of the same investment. No manual decision, no timing the market, just automatic reinvestment. And this is where dividend investing begins to show its real strength. Because once dividends start buying additional shares, those new shares begin generating dividends of their own. That's when the compounding effect begins. Let's look at a simple example to see how this works. Imagine you own 100 shares of a company. Each share is worth $20. That means your total investment is $2,000. Now, assume that company pays a dividend of $2 per share each year. At the end of the first year, your 100 shares produce $200 in dividends. If you take that money as cash, the story ends there. But if DRIP is turned on, something different happens. That $200 automatically buys additional shares. At $20 per share, your dividend purchases 10 more shares. Now, instead of owning 100 shares, you own 110 shares. Nothing dramatic yet. But the next year, those extra shares begin working for you. In year 2, your 110 shares each pay $2 in dividends. Now your dividend payment becomes $220. With DRIP turned on again, that $220 buys 11 more shares. Your total share count climbs to 121 shares. Now let's move forward to the third year. Your 121 shares generate $242 in dividends. Reinvested again, that buys roughly 12 additional shares. Now your total ownership grows to about 133 shares. And here's the important detail. You didn't add any new money during those 3 years. Your share count grew entirely because dividends kept reinvesting themselves. That's compounding. The income grows because the share count grows. And the share count grows because the income keeps buying more shares. Each cycle strengthens the next one. Early on, those increases feel small, but the process doesn't stop. Ownership expands, dividends increase, and every new share you own becomes another small income-producing asset. Over time, the compounding effect becomes powerful. There's another advantage to DRIP that many investors overlook. It removes emotion from the process. You don't have to decide when to buy. The reinvestment happens automatically. When prices fall, your dividends buy more shares. When prices rise, the shares you already own increase in value. Either way, the system keeps working. That automatic discipline can be extremely valuable during market volatility because investors often make their worst decisions when emotions get involved. DRIP replaces emotion with consistency. And consistency is what allows compounding to work. Now, combine that reinvestment with something else. Regular contributions. In this example, that contribution is just $20 per week. Every week, you add new money. At the same time, dividends keep buying additional shares. So now two forces are working together. Your weekly contributions grow the portfolio, and your dividends grow the number of shares. This combination accelerates compounding much faster than either one alone. But there's one important condition. DRIP only works if the businesses behind the stocks remain strong. If companies stop paying dividends or reduce them during difficult times, the entire process slows down. That's why stock selection becomes important. The goal isn't to find the highest dividend. It's to find businesses that can pay dividends consistently and increase them over time. That means strong cash flow, healthy balance sheets, reliable demand for their products or services. When those factors are present, dividends become sustainable. And sustainable dividends are what allow DRIP to keep working year after year. To build a portfolio designed for long-term dividend compounding, it helps to think in categories. Instead of randomly selecting stocks, we want companies that fit specific roles. In this portfolio, 4 types of dividend stocks work together to create balance. The first category is blue chip dividend stocks. These are large, established companies with long operating histories. They often dominate their industries. They have strong brands, and they generate reliable cash flow. Because their products are used in everyday life, demand tends to remain stable even during economic slowdowns. This reliability makes blue chip companies the foundation of many dividend portfolios. The second category is dividend aristocrats. These are companies that have increased their dividends for at least 25 consecutive years. That kind of record isn't easy to maintain. It requires consistent profits, disciplined management, and long-term financial strength. Dividend aristocrats help protect income because their payments tend to grow even through recessions. But stability alone isn't enough. To accelerate income growth, the portfolio also needs something else: higher income early in the process. That's where the third category comes in: high-yield dividend stocks. These companies provide stronger income from the start. That additional income speeds up reinvestment, which accelerates compounding. The key is choosing yields that are attractive but still sustainable. The goal isn't chasing extreme yields. It's finding companies that can support those payouts for years. And finally, the fourth category, dividend growth stocks. These companies might not offer the highest yield today, but they consistently increase their dividends. As earnings grow, dividend payments grow along with them. Over time, those increases can turn modest income into significant cash flow. Dividend growth stocks often become the future engine of the portfolio. When a company fits 3 or more of these categories, it becomes an excellent candidate for a DRIP-based strategy. It means the business can produce income now, grow that income over time, and remain strong enough to keep doing it for years. Using that framework, we can now begin building the portfolio itself. And in the next section, we'll walk through 5 specific holdings, each playing a clear role in turning that $20 weekly investment into long-term dividend income. Now that we understand how dividends grow and how DRIP accelerates compounding, the next step is building the portfolio itself. The goal isn't to chase the highest yield, and it isn't to guess which single stock will perform the best. The goal is balance, a portfolio where each investment plays a clear role in generating income, supporting growth, and maintaining stability over long periods of time. Using the framework we discussed earlier, this portfolio focuses on 5 core holdings. Each one contributes something different to the compounding process. Together, they create a system where income grows steadily while the portfolio itself continues expanding. The first and most important position is SCHD. SCHD stands for the Schwab U.S. Dividend Equity ETF. And in this portfolio, it acts as the anchor. Instead of relying on one company, SCHD provides exposure to a broad group of high-quality, dividend-paying businesses, companies with strong cash flow, companies with healthy balance sheets, and companies with a long track record of returning money to shareholders. This diversification makes SCHD extremely valuable. If one company struggles, it doesn't derail the entire investment. The ETF continues working because the income comes from many businesses rather than a single one. From a numbers perspective, SCHD provides a strong foundation. It currently offers a 3.59% dividend yield. Over the past decade, its dividend payments have grown at an average rate of about 10.61% per year, and its share price has delivered approximately 9.23% annual appreciation over that same period. That combination of income, growth, and stability is exactly why SCHD sits at the center of this strategy. It creates the base that the rest of the portfolio builds on. The second holding adds something slightly different: PepsiCo. PepsiCo is one of the most recognizable consumer companies in the world. Its brands reach millions of people every single day. From beverages to snack foods, the company operates in markets where demand remains steady regardless of economic conditions. People don't stop buying snacks during recessions. They don't stop drinking beverages when markets become volatile. That reliability supports consistent revenue and predictable cash flow, which in turn supports reliable dividend payments. PepsiCo is also a dividend aristocrat. This means it has increased its dividend every single year for more than 25 consecutive years. That kind of track record reflects disciplined management and long-term profitability. Currently, PepsiCo offers a 3.94% dividend yield. Its dividend has grown about 7.36% annually, and its share price has appreciated roughly 5.37% per year. It may not be the fastest growing stock in the portfolio, but it brings something just as valuable: consistency. The third holding introduces the growth engine, Federal Agricultural Mortgage Corporation, often called AGM. This company plays an important role in agricultural financing. It helps support lending across the agricultural sector, which ultimately contributes to global food production. Food demand doesn't disappear. Populations grow. Agriculture remains essential. That structural demand helps support long-term growth. From a dividend perspective, AGM offers a yield around 3.41%. But the standout feature is its dividend growth. Over the past decade, dividends have increased at an average rate of about 25.08% per year. At the same time, the share price has grown around 20.11% annually. That level of growth can dramatically accelerate income expansion inside a DRIP strategy. AGM helps push the portfolio's dividend income higher over time. Next comes Merck. Merck represents the healthcare sector within the portfolio. Healthcare has a unique advantage in investing. Demand for medicine and treatments remains steady regardless of economic conditions. People still require healthcare services, whether the economy is strong or struggling. This makes pharmaceutical companies valuable stabilizers in a dividend portfolio. Merck currently offers a 3.11% dividend yield. Its dividends have grown around 6.63% annually, and the company has delivered approximately 8.44% annual share price appreciation. This combination of steady income and moderate growth helps balance the faster-moving holdings in the portfolio. The final holding adds another layer of income and growth: Nexstar Media Group. Nexstar operates television stations and digital media platforms across the United States. Media companies with strong cash generation often return significant income to shareholders, and Nexstar has built a reputation for doing exactly that. It currently offers a 3.39% dividend yield. But what really stands out is the dividend growth. Over the past decade, dividends have increased roughly 25.62% per year. At the same time, the share price has grown around 16.56% annually. This combination provides both strong income and long-term growth potential. Nexstar helps accelerate the compounding process within the portfolio. Now that we've introduced all 5 holdings, the next step is understanding how they work together. To keep the strategy simple, we assume equal weighting. Each stock represents 20% of the portfolio. This keeps the structure balanced and prevents any single investment from dominating the outcome. Once we combine these 5 holdings, we can begin calculating the overall characteristics of the portfolio. The first metric we look at is dividend yield. And when we average the yields of all 5 holdings, the portfolio produces approximately 3.49% annual income. That's a strong starting point for long-term dividend investing. But yield alone doesn't tell the whole story. The real power appears when we also examine dividend growth and price appreciation, and that's where the portfolio becomes much more interesting. Once the 5 holdings are selected, the next step is understanding how they work together as a portfolio. Because individual stocks matter, but the real outcome comes from the combination. To keep things simple and balanced, we assume the portfolio is equally weighted. That means each of the 5 holdings represents 20% of the total investment. Equal weighting prevents any single company from dominating the portfolio. It also makes the math easier to understand and maintain over time. Now let's look at the first key metric, dividend yield. Each of the 5 holdings contributes a different level of income. Here are the individual yields again. SCHD provides a 3.59% dividend yield. PepsiCo offers about 3.94%. Federal Agricultural Mortgage Corporation comes in around 3.41%. Merck provides approximately 3.11%. And Nexstar Media Group offers roughly 3.39%. To calculate the portfolio's yield, we simply average these numbers, add them together, and divide by 5. That produces a portfolio yield of about 3.49% annually. This means that for every $100 invested, the portfolio generates roughly $3.49 in dividend income each year. At first glance, that may not seem dramatic, but remember, this income doesn't stay static. It grows, which brings us to the second metric, dividend growth. When we average the dividend growth rates across the 5 holdings, the portfolio shows an estimated growth rate of about 15.06% per year. That's an extremely important number because dividend growth is what allows small income streams today to become meaningful income streams later. If income grows at that pace, dividends can double in a relatively short period of time. This is one of the reasons dividend strategies can surprise people over long horizons. The income compounds quietly in the background, and eventually the snowball becomes difficult to ignore. The third important metric is share price appreciation. Income matters, but the value of the portfolio itself also grows over time. When we average the historical price growth of the 5 holdings, the portfolio shows an estimated annual appreciation rate of about 11.94%. This growth does 2 things. First, it increases the total value of the portfolio. Second, it supports future dividend increases because stronger companies generate stronger earnings. So when we combine all 3 metrics, we get a balanced structure. Income today from dividend yield, rising income from dividend growth, and long-term expansion from share price appreciation. Each holding contributes something slightly different. Some emphasize stability, others emphasize income, others drive faster growth. Together they form a system designed to compound over long periods of time. Now let's look at what happens when this portfolio is actually used with the strategy we discussed earlier. Adding $20 per week, that equals $1,040 per year. The process begins slowly. During the first year, the portfolio simply accumulates contributions. After 1 year, the total investment reaches about $1,040. At this stage, growth is minimal. Most of the portfolio value comes directly from the money added. But this phase is important because it creates the base that future compounding will build upon. Now move forward to 10 years. After consistently adding $20 per week, the portfolio is projected to reach roughly $22,334. At this stage, contributions are still doing most of the work. But compounding is beginning to appear. Dividends are growing. Reinvestments are adding shares. And the process is slowly accelerating. Now let's look further ahead. After 20 years, the difference becomes much more noticeable. The portfolio is projected to grow to approximately $135,192. At this point, dividends have grown large enough to make a meaningful contribution. Instead of relying mostly on weekly deposits, the portfolio's income itself begins helping drive growth. The reinvested dividends are now purchasing significant numbers of additional shares, and each of those shares generates even more income. This is where the compounding curve starts bending upward. But the real transformation appears when we extend the timeline further, because dividend investing rewards patience more than anything else. And after 30 years, the numbers become dramatically different. Now let's move forward to the point where compounding truly reveals its power. After 30 years of investing just $20 per week, the portfolio is projected to grow to roughly $820,726. That number alone is impressive, considering the total money contributed during those 30 years is only $31,200. But the portfolio balance isn't the most interesting part of the story. The real goal of this strategy was never just the size of the portfolio. The goal was income. And by year 30, that income becomes significant. Based on the portfolio's projected yield and growth, the investments are expected to produce about $57,830 per year in dividends. That equals roughly $4,819 per month. And the key detail is that this income arrives without selling any shares. The portfolio continues producing dividends while the underlying investments remain intact. This means the assets can continue compounding even while they are generating income. To understand where that value comes from, let's break it down. Over the full 30-year period, the total value added to the portfolio is projected to be around $789,526 beyond the money contributed. Out of that increase, about $487,472 comes from capital appreciation. This represents the increase in the value of the shares themselves as the companies grow over time. The remaining portion comes from dividend reinvestment. Those dividends were not taken as cash during the growth phase. Instead, they were automatically reinvested through DRIP to purchase more shares. Each additional share then generated its own dividends, and those dividends purchased even more shares. This process, repeated year after year, the snowball kept growing, and eventually the income itself became powerful enough to stand on its own. What makes this strategy so effective is not complexity. It's simplicity and consistency. There are no complicated trading strategies, no constant decision-making, no attempts to guess when markets will rise or fall. Just a few high-quality dividend investments working together over time, and a small weekly contribution that remains consistent. The system works because each part supports the others. The dividend yield provides income today. Dividend growth steadily increases that income year after year. Share price appreciation strengthens the companies behind the dividends. And DRIP keeps reinvesting every payment automatically. Together, those forces create compounding. And compounding is what turns small amounts into meaningful results. It's also important to notice something about this strategy. It doesn't require large starting capital. It doesn't require perfect timing. And it doesn't depend on finding the next big stock. Instead, it depends on something much more reliable: time, consistency, and strong businesses that continue paying their owners. Those three things working together are often far more powerful than trying to chase the next big opportunity. Because investing success rarely comes from one brilliant decision. It